Investment Partners is an investment management firm that manages portfolios invested within managed accounts. We manage direct assets and securities that are transparent and easy to understand, run by good management, priced below their valuation, and display attractive growth prospects. We follow a rigorous process that aims to protect wealth and reduce investment risk in volatile times. Our philosophy has evolved from the frustration experienced via the global financial crisis. This includes a lack of transparency in many fund manager portfolios, many fund managers taking a passive approach to portfolio construction, achieving index returns whilst charging active management fees, and fund managers having inflexible investment mandates which don't allow them to exit asset classes when they can clearly see that specific asset classes are in danger of market correction, such as during the GFC. Our experience with clients has shown us that investors are not only looking to fund managers to use their expertise to create wealth, but are also looking to fund managers for protection of that wealth when asset bubbles or unfavourable conditions present themselves. This belief has reinforced our investment philosophy of delivering excess risk-adjusted returns by undertaking an active approach of investment within undervalued assets with a focus on wealth preservation and risk reduction. The majority of assets and securities are held directly, for example specific Australian shares, with managed funds only used in asset classes such as international shares and global bonds, where the market is too extensive for direct asset ownership. The benefits of holding assets directly are that all assets are clear to see and easy to understand. There's more control over securities held, corporate actions and tax outcomes, thereby reducing capital gains tax. Assets can easily be moved in and out of platforms without triggering capital gains tax. And fund manager risk is significantly reduced as investors do not hold units in a fund. Direct assets are selected by a quantitative and qualitative investment screening process. The quantitative screen assesses and ranks assets in terms of valuation and performance potential, looking at several metrics in each of these areas to rank assets. Then the qualitative screen considers external factors such as political, technological and economic factors, competitive factors such as competitive landscape, competitive position and competitive advantage, and company-specific factors such as company strategy, management, financial position and risk. These screens provide the investment committee with a smaller amount of recommended assets with which to construct the portfolios. Our portfolio process is implemented within our blended portfolios, VIP Conservative, VIP Balanced and VIP Growth, via our proactive, strategic and tactical asset allocation process. Step 1 is our strategic asset allocation step, which begins with a strategic allocation to asset classes for each of the blended portfolios based on the split between growth and defensive assets. For instance, the balanced portfolio has a 60% allocation to growth assets, being shares and property, and a 40% allocation to defensive assets, which include cash and fixed interest. Then follows our tactical asset allocation process, which considers whether specific assets within the allocation are providing sufficient reward for risk, based on various factors ranging from asset-specific factors to overarching macroeconomic factors. To analyse this, the investment committee considers asset-specific pricing, sector valuation and fundamentals, and domestic and global macroeconomic considerations. If these factors deem to present an unfavourable situation, we will hold an underweight position in the asset ranging all the way down to 0%. For instance, the balanced portfolio's asset allocation can move across a maximum tactical range of up to 70% in growth assets, all the way to 100% in defensive assets. A real-life example of this occurred in September 2011, where investment markets were extremely concerned about the prospects of a Greek financial default prior to the European Union announcing a bailout plan. Our diversified portfolios were quickly transferred to defensive assets, with the balanced portfolio as an example, reducing Australian share allocation from 40 down to 15%, international shares from 10 down to 0%, and increasing fixed interest and defensive assets from 40 to 70%, thereby protecting investors' portfolios and delivering on our value proposition of wealth protection.